Well, the dawn of a new year and a new decade for stocks and the dollar. What can investors expect in the days ahead? Dennis Gartman is an economist and editor of the daily Gartman Letter, and he joins me now from Virginia Beach. And Dennis, as I understand it, you just made it to our camera, so good to have you here.
It was close. I wasn't sure I was going to make it.
Okay, well, we're glad you did. And, you know, Dennis, you've been talking about the dollar all throughout 2009, so that is where I want to start, because you're pretty bullish on the greenback. We're starting off 2010 a little bit weaker on the U.S. dollar. Why are you so bullish?
Well, I think there's a number of things. One, everybody and his brother is terribly bearish. Not as bearish as they were a month and a half ago, but still overwhelmingly bearish. I think you'd also see that the states are going to see stronger economic growth compared to what's going on in Europe. I think there are problems that Europe has. We obviously have seen some fraying at the edges of the union. Greece obviously has problems. Spain has some problems. Portugal has some problems. And as long as those problems exist, the propensity of people to move money to the European Union, I think, is going to be relatively minimal. So I think that will inure to the benefit of the U.S. dollar. The only currencies of which I'm bullish against the dollar are going to be the Canadian and the Australian. They're going to benefit because of global economic growth and the demand for commodities.
And yet some would say, though, and as you and I have observed throughout 2009, is this inverse relationship between the dollar and stocks. So the fact that you see a rebound in bullishness on the dollar, does that mean then you see a softer equity market in 2010?
Actually, Betty, I think too many people have gotten to the point where they believe there is this lockstep relationship between a weak dollar and a strong stock market. Actually, over time, there is no correlation between stock prices and a currency or a nation's currency. If a weak currency gives rise to stronger stock prices, please explain to me why last year you had a very strong euro and yet the European stock markets went up. The correlations, I think, are skewed at best and asymmetric more often than not. And therefore, I'm bullish of stocks, but I'm also buying the dollar to hedge it.
But then why do you think that? Because it wasn't as if people just made this up. I mean, they had observed that, in fact, there was this inverse correlation. I mean, then in 2010, does that mean that that correlation weakens or what?
I think that correlation held from about March of last year until December of last year, and people's memories are very, very short. Prior to that, the correlation between the dollar was that you could actually have strong stock prices and weak dollars. You could have strong stock prices and strong dollars. You could have weak stock prices and a strong dollar. Over protracted periods of time, the correlation between a nation's currency and its stock market are ephemeral. So as people became absolutely believed thoroughly that the dollar had to weaken and stock prices went up, my propensity is to take the other side of the trade. I'll buy stocks, but I'm also buying dollars.
Okay, all right, Dennis.
I bet that correlation breaks down.
Okay, Dennis, we're going to have to leave it there, but good to talk with you as always, and Happy New Year. Dennis Gartman, editor of the Gartman Letter.